Welcome to January 3rd, 2026. While the world was busy celebrating the new year, the global financial architecture quietly suffered a catastrophic fracture. As you woke up today, a decade-long lie finally disintegrated. For years, we at Legacy Economics warned that the paper price dictated by Wall Street was a digital hallucination. This morning, that hallucination met a brutal reality. In the physical markets of Tokyo and Shanghai, silver is being traded for a staggering $180 per ounce. Meanwhile, the New York COMEX is desperately flashing a price of $32. This isn't a minor discrepancy. It is a $150 chasm that signifies the total brain death of the Western pricing mechanism. The decoupling has happened, and the system is officially broken beyond repair. The primary catalyst for this explosion was the official activation of China's silver export licensing regime on January 1st. China, which controls over 70% of the world's refined silver supply chain, has effectively slammed the door shut on the Western world. Beijing is no longer interested in trading real, strategic metals for depreciating fiat currency. If you are a Western industrialist, whether you're Tesla, Apple, or a major solar manufacturer, you now have to beg for a license that is increasingly impossible to obtain. When the world's largest supplier stops the flow, paper silver in New York becomes nothing more than a receipt for a metal that isn't there. The East has the metal, the West has the ink. In a normal market, a $150 price difference would trigger a massive arbitrage opportunity. Buy in New York for $30 and sell in Tokyo for $180. But there is a terrifying reason why this isn't happening. There is no physical metal available for delivery in the West. The exit door is locked. Japanese investors are panicking because they realize their currency, the yen, is in a terminal death spiral, and they are willing to pay any premium to secure hard assets. New York bankers are trying to hold the $32 line to prevent their own insolvency. But you cannot bridge a $150 gap with empty promises. The COMEX and LBMA have become irrelevant. The real price discovery has moved to the East. Why is the price still $32 in the US? The answer lies in the extreme leverage of the fractional reserve bullion system. As of 2026, the paper-to-physical ratio has exceeded 1,000 to 1. This means for every single ounce of physical silver sitting in a vault, there are 1,000 digital claims held by unsuspecting investors. If even 1% of those contract holders demanded their metal today, the entire system would default instantly. This $30 price is a digital cage designed to keep the masses from realizing that the silver they think they own simply does not exist. At Legacy Economics, we deal in sovereignty, and sovereignty cannot be found in a digital digit. For decades, JP Morgan was the undisputed bully of the silver pits, using massive naked short positions to suppress prices. But in 2026, the predator has become the prey. Their short positions are now so underwater that a move to the real price of $180 would wipe out the bank's entire balance sheet. They are trapped in the largest short squeeze in human history. To survive, they are working with the Federal Reserve to dump millions of fake ounces into the market every hour to keep the price down. But the East is calling their bluff. Every time JP Morgan smashes the price, China and Japan buy the dip and demand physical delivery, draining the vaults even faster. The final week of 2025 saw the largest vault drain in recorded history. Over 60% of the registered silver on the COMEX vanished into private hands. Wall Street analysts called it a technical adjustment, but we know better. High net worth individuals and sovereign funds, the whales, are pulling their metal out of the system because they no longer trust the exchanges. When registered inventory hits decade lows while demand hits all-time highs, a price of $38 is a mathematical joke. Japan's $180 rate is the true market value. America's $32 is a state-controlled lie designed to protect the too-big-to-fail banks. In 2026, silver has transitioned from a commodity to a geopolitical weapon. By classifying silver as a strategic national mineral, China has put a chokehold on the U.S. tech sector. Silicon Valley cannot produce AI chips, high-end electronics, or next-generation military hardware without silver. This is a silent war being fought with atoms rather than bullets. The U.S. dollar's sovereignty is evaporating because it is backed by nothing but debt, while the emerging BRICS order is backing their future with hard commodities. Legacy Economics believes we are witnessing the birth of a new gold and silver-backed world order. We have officially entered what insiders call Ghost Week. This is a period where you see a price on your screen, but you cannot find a single ounce for sale at that price. If you go to a local dealer today, you will see sold-out signs everywhere. Premiums on physical coins have spiked to 200%. The system is attempting to ghost the retail investor. They want you to see $32 and think silver is cheap, but they will not allow you to buy it at that rate. This mechanism is designed to keep you in the dollar trap until the very moment the currency is devalued overnight. There's a darker side to this crisis, the bail-in protocols. If the major bullion banks fail due to the silver short squeeze, they will not be bailed out by the government this time. They will be bailed in by your deposits. Under the updated 2026 banking laws, your savings account is technically an unsecured loan to the bank. When the system breaks, your digital balance can be converted into worthless bank equity. This is why Japanese citizens are paying $180 for silver. They know that a $180 hard asset in hand is worth infinitely more than a $100,000 digital balance that can be frozen with a single keystroke. The industrial demand for silver in 2026 has reached a terminal bottleneck. There is no replacement for silver in solar panel manufacturing or electric vehicle power grids. Solar companies are now in a state of desperation buying. Unlike paper traders, these companies need the actual gray metal to keep their factories running. When a multi-billion-dollar corporation realizes it cannot fulfill its contracts due to a silver shortage, they will bid any price. Japan's $180 rate is a reflection of this industrial panic, a panic that is about to go global as manufacturers realize the COMEX vaults are empty. The ultimate question is, when will the COMEX officially default? It happens the moment a major entity, perhaps a sovereign nation or a tech giant, demands 10 million ounces of physical delivery and the exchange cannot provide it. At that point, they will declare force majeure. They won't give you silver. They will give you a cash settlement in paper dollars at the fake price of $32, while the real price outside is $180. This will be the greatest legal robbery in financial history. If you don't hold it, you never owned it, a principle that is being proven true in the most painful way possible in 2026. With President Trump's new Federal Reserve pick set to take office this month, the market is on edge. Trump has signaled a desire for lower interest rates to boost American manufacturing. But in a world of silver shortages, lower rates act like gasoline on a fire. If the Fed pivots to rate cuts now, silver will hit $300 overnight. The political pressure to keep the system alive is clashing with the mathematical reality of a collapsing dollar. Legacy economics is monitoring every political move, as a single executive order could now remonetize gold and silver in an instant. The CME Group just raised silver margin requirements by 30% in the last 24 hours. This is the bank's final weapon against retail investors. By raising margins, they force small traders to put up more cash or sell their positions. It is a psychological attack designed to create a fake sell-off. They want to shake you out of your position so they can buy your silver at a discount to cover their own massive debts. You must understand that the price on the screen is a weapon used against your emotions. Don't watch the screen, watch the vaults. The vaults are telling the truth, and the truth is that the metal is gone. This $150 price gap is a systemic fracture. Just as a crack in a dam precedes a total collapse, this divergence signals that global liquidity has dried up. Capital is fleeing jurisdictions with high counterparty risk, like the US paper markets, and flowing toward jurisdictions with hard assets, like the East. We are witnessing a capital flight of historic proportions. The West is becoming a financial island, isolated from the real world of commodities. This is the beginning of what globalists call the Great Reset, but it's happening on the people's terms, not theirs. In 2026, the demand from AI data centers has become silver's new black swan. AI chips require silver for their superior conductivity. Silicon Valley titans have been quietly hoarding physical silver for the last 3 months, bypasses the exchanges entirely. They don't care about bank balances, they care about server uptime. When big tech starts bidding for silver against big banks, the $180 price will look cheap. We are in an era where silver is both money and industrial fuel, a dual role that makes it the most undervalued asset on the planet. Every day, we see the dollar's purchasing power falling off a cliff. $180 silver doesn't mean silver is more expensive, it means the dollar is worth less. The dollar is a debased currency that the world is dumping. Japan has begun selling its US Treasury holdings to save its own currency, and that money is flowing directly into physical silver. We are in the final phase of a currency war, where the only survivors will be those holding real assets. Legacy Economics is your guide through this storm, showing you the path to safety before the dollar hits zero. Technically, silver has established a permanent floor at $75. Even if the paper price is manipulated down, there are millions of buyers waiting at that level. The $32 paper price is a last call for anyone who can still find physical metal at a reasonable premium. The market has accepted $75 as the baseline, and Japan's $180 rate is a preview of the year-end target for the West. The system is fundamentally broken, and from here on out, we expect maximum volatility as the old world dies and a new one is born. The core principle of legacy economics is generational wealth protection. If your silver is in an app or an ETF or a broker's account, you are at the mercy of the system. In the banking crisis of 2026, account freezes will become commonplace. Only wealth that is sovereign, and wealth that you hold in your own possession, is truly yours. Japanese investors understand this. They are paying the premium because they know a $180 hard asset is a legacy, while a digital promise is a liability. You must choose which side of history you want to be on. The next 48 hours are critical. We expect a massive gap up when the markets fully digest the scale of the China export ban. The COMEX will be forced to adjust its price or face total irrelevance. We may even see trading suspensions as banks surrender to the inevitable. When you see trading halted on the news, know that the bankers have lost. Legacy economics will keep you updated every hour to ensure you remain 2 steps ahead of the collapse. The music has stopped, and it's time to find a seat. Time is up. This $150 gap is your emergency siren. The window to secure physical silver is closing, and once the supply chain is fully frozen, no amount of money will buy you an ounce. This is the greatest wealth transfer in history, and it is happening now. Protect your family, protect your legacy, and protect your future. The New Year celebrations are over, and the era of survival of the smartest has begun. Subscribe to Legacy Economics for the daily truth and prepare for the world that is coming. Thank you for watching.